guess so much for lunch. We'll get started. Let me try to bring our subject home a little closer, perhaps, and compare it to the subprime mortgage crisis that we've gone through, and the similarities or dissimilarities to the European sovereign debt crisis. The similarity would be that you could say in both cases you had borrowers who were borrowing amounts that they could not expect to repay realistically except under quite favorable assumptions. The favorable assumptions in the case of the subprime mortgages was the ever-rising home price appreciation. In the case of the subprime sovereigns, it had to do with the ability to sustain ever more generous levels of government outlays depending on revenues that obviously could not withstand any significant downturns. So the ultimate outcome was the optimistic assumptions were not fulfilled. And then the question became, from the standpoint of the borrowers, they would like to keep what they bought but couldn't pay for. And from the standpoint of the lenders, they would like to not suffer the losses from their imprudent loans, imprudent at least in hindsight. Let me begin with Daryl. How would you distinguish the two situations, and how should we look at the European sovereign debt crisis?
In some senses, at least in the sort of near-term historical perspective, this is one long continual crisis that started with a general increase in global indebtedness at the beginning of the last decade. But I would make a pretty important distinction between the way that the crisis of 2008, 2009 propagated and the one that we're looking at now, which is much more structurally embedded in the very fabric of Europe. In fact, I would go back, even if you don't mind taking it from a very long lens of history, going back early into the 20th century when Europe was shattered by two very damaging world wars. And the leaders of Europe after that decided to use economic union as a tool to integrate Europe and mitigate the likelihood that we'd have any sort of disasters like that again. That union became larger and tighter, and in around 12 years ago, there was an attempt to cement it with a monetary union that is the Eurozone, that is the use of a single currency with a single central bank controlling monetary policy. Primarily, although there are many economic advantages to that, primarily as a method of ensuring that these European countries would remain tightly integrated and less likely to fly apart and go at each other again. Read Helmut Kohl on that, former German chancellor. Moving ahead, I mean, even at that time, it was decided that by many observers, such as Martin Feldstein, the then president of NBER, National Bureau of Economic Research, that this monetary union would not succeed because it was not also a fiscal union. It's a long answer to Ken's question, but it sets a stage for a crisis which is quite distinct from the mere over-indebtedness of homeowners and financial institutions and increased leverage that we saw in the United States. The setting for the European debt crisis also includes extreme over-indebtedness, not just by sovereigns but by banks. But the intractability of this crisis and its depth is really deeply structural because of this commitment to union, and at the same time, the absolute inconsistency between a monetary union on the one hand without a fiscal union as we have more or less in the United States. The analogies between Europe and the US have been made, but they're not as close as many have suggested. I could go on from there, but I think the common element is deep indebtedness. The difference is intractability based on a much different political foundation and historical foundation.
Okay.
It's kind of curious. I just say one thing on that. As a as the subprime crisis was developing here, one of the concerns that we had, those of us who practice in the financial institution space, was that there were too many regulators to deal with for there ever to be a simple, easy solution to the problem. And what we faced with the Federal Reserve, the Board of Governors of the Federal Reserve, and the FDIC, and the Office of Thrift Supervision, and the Office of the Comptroller of the Currency, is nothing in comparison, of course, to what Europe faces in terms of its fragmentation from a fiscal governance perspective, which, you know, obviously contributing, as Daryl indicates, greatly to the intractability of that issue for them.
When the subprime mortgages imploded, then that generates a lot of losses. And the losses, well, one of the questions that's been going on in this country, and one of the questions that's now going on in Europe with the sovereign debt crisis, is who's going to eat the losses? And in the first instance, the losses were on loans, and the loans were either now still held by those who made them, or in some cases transferred to others through securitization or syndication or what have you. Have you seen we certainly saw the consequence of the losses hitting the financial institutions in this country, and the freezing of normal flows of credit and the spillover effects that had rather quickly on the real economy. Are you seeing anything here comparable to that from the European crisis?
Definitely, we are seeing the impact of the European, whether you call it the, whether it's the euro sovereign debt crisis or the euro banking debt crisis. We're definitely seeing spillover effects, although it's not necessarily as direct as it was, of course, during the subprime crisis. So for me in particular, I can tell you that, again, I do spend half my time in capital markets transactions, so companies going out there to raise equity or raise debt to finance their business. And it seemed that we had turned a corner last year, maybe the end of 2010 or into 2011, and a lot of people got bullish about the IPO market. So companies like Facebook coming to the market for the first time and going through a registration process with the Securities and Exchange Commission that can take 3, 4, or 5 months. And there were deals that we started back in the late spring of 2011 that were primed or designed to be ready to go in the fall of 2011. And lo and behold, what happened in the fall of 2011 is that every day bankers and their clients would be monitoring the situation in Greece or somewhere else in Europe to see what the ramifications would be and what the spillover effect. And so the immediate effect, or at least so far, has been a great degree of volatility and uncertainty that has actually stymied the efforts of some companies here in the U.S. to be able to raise capital in the public markets, not because their businesses are necessarily tied to Europe, not because they're necessarily selling things in or out of Europe, but simply because, again, the uncertainty generated within capital markets by what might happen in Europe and what the entanglements might be is enough to cause people not to go forward with their plans.
In the U.S. case, the losses hit the banking system fairly directly and promptly. You had Bear Stearns fail, then you had Fannie Mac fail, then you had Fannie fail, then you had Freddie fail, then you had Lehman fail, Then you had AIG essentially fail because of their backup guarantee role in all of it. It doesn't seem to have yet hit the banking system in Europe in quite as visible a way.
Well, that's because the meltdown hasn't happened, at least yet, although there is still some chance of that. We actually have, thanks to one of the rare cases in which the Europeans have been clear about the assets sitting on the balance sheets of their European banks. We have from July 2011 their stress test for sovereign debt, and we know that at least based on market prices, which include the effects of likely default, that European banks have a shortfall of anywhere from 100 to your guess, say 300, depending on which of those sovereigns debts you write down and how you mark the other assets on those balance sheets. Clearly, the European banks are undercapitalized. The fact that they haven't failed at this point doesn't mean that they're not under extreme stress. As most of you know, the likelihood of a disaster, which I put it to my friends at around 35% or so last October and November, has reduced. I now put it at around 15% in the next year, thanks to the heroic measures of the European Central Bank to shore up the liquidity, not the solvency, but the liquidity of European banks with massive, unprecedented 3-year long-term refinancing operations, which are essentially loans collateralized by assets of questionable quality of those banks for 3 years under very generous terms. So that gives us some breathing space, but that doesn't mean that the bank's capital is any better than it was last October. It merely means that they have more time to recapitalize. If they do not, and they're not being forced to by their regulators at this point yet, if they do not, then we'll be back in the same situation that we were in October within the next 3 years, if not sooner, should something go wrong. Now, 15% may not sound like an alarmingly high number for a meltdown of the European financial system, but for bond investors or macroeconomic, those watching the macroeconomy, anything more than a few percent of the likelihood of a disaster of that type is extremely dangerous, and the European banking system would certainly be on the front line of that if it should happen because of the likelihoods of runs.
So as this unfolds, who is going to eat the losses? The losses are real, the losses are there. And we have the question as to what extent does it fall on the borrower, the Greeks themselves? To what extent does it get transferred to the European Financial Stability Facility? I see they like the word facility better than fund. Right. The IMF is being looked to by some as a way to take the loss, but then the IMF has to raise more money to do so, and that brings it back home to us as, what are we paying, 27% or something of the IMF funding. You have the European Central Bank, which does not want to assume the role of the bailout fund. You have the banks themselves, which can look to their own governments in some cases for bailout money. And the rest of Europe seems to think that the obvious candidate to eat the loss are German taxpayers. How is it going to play out?
Well, on that score, I have to congratulate Kendall and the Rock Center for the timing of this meeting. We're right in the middle of finding out. There are simultaneously, believe it or not, 3 parallel series of negotiations over exactly that question. There is the so-called PSI, or private sector involvement negotiations. Which of the banks will suffer how much on their Greek bonds, setting a precedent for Portugal to come. Then we have the official sector involvement. You alluded to the ECB. There are also national central banks, which have significant holdings of Greek bonds. There's the Troika includes the IMF, which also has substantial involvement. And of course, as you said, everybody that invests in the IMF stands to lose. And then the third track is the simultaneous round to re-up on the next tranche of loans to Greece, which will involve substantial additional losses for whoever is willing to lend, donate to this next round. With respect to the IMF, their senior, if you look both to the current agreements and to the upcoming agreements, the new European Stability Mechanism Treaty, which was signed last week, February 2nd, makes it very clear that the European sovereigns will subordinate themselves to the IMF and probably to other supranationals or to investors like China who might be willing to put funds to the IMF for this purpose. Then will come the official sector in Europe. The ECB has indicated that informally that it will take losses, not relative to the price of its investment, but relative to its claims on Greece. It has about 55 billion in claims, and it's probably willing to sell those claims to the EFSF that you cited for about 40 billion, the price that it paid, not losing anything, but not extracting the last penny of value. That's still being worked out, whether the other European national central banks will participate, what direct loans from sovereigns will have to get written down. But I actually think these are all, these direct losses are quite secondary to what Patrick referred to, which are the macroeconomic spillover effects, risk aversion by investors, slowdown of the global economy, should this not go well.
What do you see as the stake of U.S. institutions, U.S. banks, in exactly how this allocation of losses is made in Europe, and how quickly or slowly it is drawn out?
Well, I'm sure Darrell can elaborate on this to a more educated degree, but from my understanding, the direct exposure of U.S. banks to Europe, to European banks or European sovereigns, is not as great as one might fear. But again, I'm not sure that it's that direct exposure by which us in the U.S., our financial institutions, our capital markets, et cetera, are going to suffer based on whatever happens in Europe. It's going to be the indirect effects of a slowdown in Europe, which might lead to a slowdown of our own economy, even though Europe is not. We have many trading partners around the world, and Europe is actually relatively a smaller part of that. But nonetheless, I think it's those indirect effects through which we're more likely to be damaged than it is the direct exposure to the European sovereigns.
Money market funds are now almost completely out of Europe? U.S. money market funds?
I wouldn't know that, but Darrell, is that?
Yeah, well, as of last summer, they had an alarmingly high exposure. Had the crisis come to a head then, it would have been another disaster, possibly the same thing that happened after Lehman went down, when money market funds nearly melted down. And at this time, we do not have the ability, the federal government of the United States is no longer able, at least so it says, to support money market funds. So that would have been a very, very bad situation. But as you alluded and Patrick suggested, current exposure of U.S. prime money market funds is well down. However, European money market funds still have very substantial exposure, as do securities lenders and those that enter into repurchase agreements based on European debt. We know about MF Global, but of course there are many others like that.
It's interesting that some of the efforts that are underway right now in Europe to solve the crisis or to prevent the further spread of the issue are similar in many respects to what now has been vilified in the U.S. in terms of bank bailouts. And sometimes people remember the acronym, sometimes they don't. It was TARP, the Troubled Asset Relief Program, which I don't know, from my perspective, played a significant role in preserving our financial institutions and our capital markets the way that we know them. But today is a bad word if you're running for president. And nobody seems to question that. I'm just interested in that, in anybody's perspective on that. Nobody seems to question that the European counterparts are now struggling with the same issues themselves, but none of them, or few, are suggesting the alternative of walking away and letting the free market deal with the sovereigns that should default in some people's views.
I agree with that.
Well, part of the issue there, I suppose, is we had one government and the Eurozone has, what, 17?
Correct.
So you're allocating losses not only within societies, but you're allocating across different countries. And
Right, and they'll say that different authorities there have different interests in mind, so that perhaps, you know, the European Central Bank is thinking more about German banks and saving them and preserving their long-term health at the expense perhaps of those bondholders and others who lent to Greece or those who have since invested in Greek bonds. And I don't know, it's a very interesting political dynamic, much more complicated than our own.
if the, if the greatest stake is to prevent significant spillovers from the financial to the real economy, do you think they're achieving that?
Thanks to Mario Draghi, yes, I think at least temporarily.
He's the European Central Bank president now.
Yes.
Yeah.
He has been quite heroic and kept to the mandate of the ECB by not making direct transfers to European sovereigns, but rather following his mandate of the ECB to support the European financial system through its banks has, as I mentioned earlier, dramatically lessened the likelihood of an immediate problem and given time for the European banking system to heal. Whether the banks and their regulators take advantage of that opportunity remains to be seen because they need to raise capital. Merely that liquidity will not do it.
What do you think is the aggregate amount of capital that they're looking at having to raise?
Well, the European Banking Authority has required by this summer 115 billion euros. And last 2 weeks ago was the deadline for the banks to demonstrate their plans to raise that capital. Very few banks, the only notable one being UniCredit, the Italian bank, has actually raised capital in a significant rights offering, bashing its shareholders in doing so, but it needed to do that to be safe. Still not completely out of the woods. The other European banks are not actually going out to raise new capital. Instead, they are rejiggering their balance sheets and either by putting different risk weights on the assets that they now hold, suggesting that they're not as risky as they were marked last year, or selling assets, which sometimes works and sometimes doesn't, and refusing to make a lot of the kinds of loans that they would have been able to make had they had more capital. I've talked to a number of people, the range of estimates on how much more capital would be needed to return that banking system to health range from the floor, which is the current EBA requirement, to ceilings of well over 500 billion euros. And you can actually, there's a little tool available from Reuters where you can dial in how much of each sovereign's debt you think will have to be written down to determine bank by bank. It's quite remarkable because of the stress test last summer, we now know, bank by bank, how much additional capital would be needed. And if you dial those numbers up to what I would consider moderately reasonable levels, you get to around 400 billion or so euros of additional capital. That's assuming that all the other assets, corporate loans and so on, are being marked reasonably accurately, which again, I have my doubts about.
And you wonder why is it these banks don't take more immediate steps to recapitalize their balance sheets? And the same dynamic played out here 2 to 3 years ago, whenever it was, in the sense that, you know, we talk about too big to fail, right? But it really is a mentality that permeates certain aspects of our economy. And you can imagine that there's some management teams in Europe and elsewhere that think to themselves, if I hold on just long enough, there will be that, you know, either through the liquidity prop or some other measure taken by a regulatory authority, I will be able to avoid the level of dilution to my existing shareholder base that would otherwise be implied by these levels of recapitalization. And it's a dangerous mentality, right? I mean, it's understandable on the one hand. You know, you have certain obligations to those people who have already invested in your enterprise. But how far you can push it, how far you can kick the can down the road before you have to take the steps to sell assets, raise
capital,
you know, it's a gamble.
I guess the poster boy for that view of the world is Richard Fuld, who was the longtime head of Lehman Brothers and who explored various avenues to try to recapitalize or improve the position of Lehman, which involved, in his view, unacceptable dilutions of current shareholders, and thereby rode the dilution down to zero, which is a lesson that one would hope would have been learned by others. But of course, what he was expecting was that there would be some kind of government rescue,
Right.
government bailout. And do you think that is still fueling the situation and the behavior of the banks in Europe?
I think the banks have influenced their regulators into believing that they don't really need to raise very much new capital. The EBA numbers were not a pleasant news for the banks, but they have been able to convince their regulators that they can meet these capital requirements without. In fact, they advertised immediately after those EBA requirements, don't worry, shareholders, we will not actually go out and issue shares to raise new capital. We will be able to deal with this without raising capital. They literally attempted to calm their shareholders, and it is in shareholders' interest, if you take that narrow perspective, for them not to raise capital, because those shareholders lose the option to walk away if they become insolvent, and if they with more shares, they would only share a portion of the upside if they happen to come out of this. They probably will come out of this. Things will probably work out, but just knowing that the likelihood is reasonably high that they'll muddle through and this will all be fine, to me is not sufficiently comforting. I would like to see their regulators tell them to go out and issue new shares and get more capital on their balance sheet.
When you were putting realistic assumptions, in your view, into your evaluation tool, what write-downs on sovereign debt, Greece, Spain, Portugal, Italy, were you feeding in?
I was feeding in the market estimates at the time, which was, the last time I did it was around the end of November. Things have improved somewhat. The financial sector in Europe, the prices are higher now on those debt instruments. I basically wrote off Greece, which I think is pretty much realistic. I don't think
100%?
Well, no. The current private sector involvement, which involves mainly banks and a few insurance companies, suggests that the market value of the claims they will get coming out of that negotiation will be worth around 30%.
Yeah, 70%.
70% haircut of what their claims are. Now, to be fair, many of those banks, not all of them, but many of them have already written down those assets, those sovereign debt assets, on their balance sheets to around 50%, because that's the headline number for this restructuring. But additional write-downs would be appropriate. When you get to Italy and Spain, the markets have healed quite a bit since November. I haven't redone the calculations, but if Portugal were to follow Greece into a restructuring, people would start pointing their fingers at Spain and Italy. It's not likely, but it's possible that significant reductions in market value would occur. Those bank balance sheets are heavily levered. They have 3 years of a timeout, thanks to the ECB. So we do have time to work this out. This is a great thing that Mario Draghi has done.
But wouldn't you say that your expectation, or would you say that your expectation is still that there's enough spillover in various channels that growth in Europe over the next 3 years is going to be anemic?
Yeah, even official European forecasts of growth are essentially 0 or so this year, possible recession. And official forecasts tend to be somewhat optimistic. And it's anybody's guess. If things turn around this year, both in the U.S. and this starts to heal over in Europe, there's a lot of cash on the sidelines. There's a lot of unemployed workers in Europe. The unemployment rates are remarkably high. There's plenty of spare capacity to grow Europe rapidly if things can be stabilized. And it's, that non-disaster scenario includes some very bright growth possibilities. So who knows?
Let me turn to a silver lining in this cloud, which is, from the standpoint of lawyers, the prospect of a breakup of the euro opens up all kinds of complicated questions that only lawyers can properly address. I'm sure you would agree.
Yes.
You've got trillions of dollars worth of contracts and instruments and securities denominated in euros. There is no provision in the monetary union agreements as to if a nation did leave the euro. Greece is obviously the one everybody is contemplating. So there is no calculatable exit route. And so if the euro broke, then there would be legal complications that would mean great employment for the profession for some years to come. Although I must admit, I don't think it's anything that is contemplated and we are preparing students for in our curriculum or anyone else's. I mean, all kinds of choice of law questions, lex monetae questions, lots of questions. What's going on in this regard currently in the legal world?
Well, there's a lot of, planning would be the wrong word, but there is a lot of speculation as to, I guess, what you call the silver lining for the legal profession. You know, the thing about being a lawyer, and this is when you get to pat yourself on the back for being in law school, is that, you know, your clients need you when they're having, in the good times, and they need you in the bad times. And not only in this regard, and I'll touch upon that in a minute, but, you know, the other, from a U.S. lawyer's perspective, another silver lining, so to speak, might be that a lot of these European banks do need to divest assets as a means of shoring up their balance sheets. And some of those assets are here. Some of those assets are banks that are, you know, or other financial institutions that have weathered the storm here and are decent franchises. And so there will be opportunities, you know, for lawyers to assist some of the European banks in divesting these assets here and around the world. You know, in terms of that sort of quagmire, it's funny, about a year ago, you know, in the investment grade bond space, people began, you know, when somebody would go to do a euro-denominated bond, meaning that the principal amount of the bond and its interest payments are in euros, people began to build into it clauses to deal with the situation where the euro broke apart, and what after, you know, what would you do with the bond in that circumstance? Well, you know, the funny thing is that they only started thinking about that a year ago, and so there are a lot of longer-term euro bond maturities that are outstanding that don't have a default for what happens if there were no euro. You know, I think it's a fair statement, Ken, that if the euro were to break apart, if one member were to leave, there'd be a lot of work for lawyers in trying to clean up the mess.
Daryl, suppose that there's a political dimension to all of these issues we've been talking about. What will what will politicians agree to? What will voting populations accept? People do not like to lose what they thought they had, even if what they thought they had was in large part an illusion or unsustainable. So suppose that you know, the riots in Greece mean that you can't broker a deal along the kind that they are trying to put together, that they think maybe they are close to getting but haven't gotten yet, either economically or politically. Suppose that it doesn't come through and there is a default, then what do you think?
There's two kinds of default. There's the kinds that are planned ahead and the kinds that are not. And in the case of Greece, planning ahead, it could come out actually much better for Greece than the current restructuring if they decide to. I mean, a restructuring is is by any other word, it's really a default. You're not paying the obligations that are due. Default would mean that you can't negotiate the official sort of default that we're talking about. You couldn't negotiate your way out of the restructuring talks, and you had to simply say, I'm sorry, we're not going to pay your bonds. If they were to do that in an orderly fashion, Greece, with the assistance of Europe, if it could get it, would be much better off.
What do you mean by orderly? One bond at a time, or what's orderly?
I mean that in some quiet room where there are no journalists, anybody else watching, a plan is worked out by which the banking system of Greece would be nationalized or recapitalized with the assistance of probably the ECB, using funds from the sovereigns of Europe, whether through the IMF or directly. This would have to be negotiated very quietly in a way that when Greece announces that it will not be it's unable to meet its obligations under its bonds, nor can it restructure the bonds in a way that's satisfactory to the bond investors.
The next installment comes in March.
Yeah, March 20th. If it's done in an orderly fashion, in the same press release or statement, they will be saying, and we have taken steps to ensure that our banks are well capitalized and able to meet all liquidity demands. And they would need to do that in a credible way, because the alternative is what is known as a disorderly default, in which all hell breaks loose, including civil unrest, runs on banks, dramatic, not recession, possibly depression of the Greek economy if that were to occur. And then, of course, the spillover effects would not so much hit, Italy. People would be aware that there's a distinction between Italy and Greece, but they would shake up investors in a manner that Patrick suggested earlier. They would cause negotiations with Portugal, which is going to be following down this same path fairly soon, to be much worse. Possibly destabilize Portugal's banks, which are very weak right now because of the same overinvestment in their own sovereign bonds. That disorderly default, it must be avoided at all costs, at least for the economic welfare of the citizens of those particular countries, and of course because of the macroeconomic spillover. That's paramount. I think that the more orderly form of this, possibly through these negotiations, which are supposed to finish today, or they were supposed to finish yesterday, is probably going to happen. But remember that Lucas Papademos, who is nominally the Prime Minister of Greece, is in fact sitting in a chair suggesting and providing technical advice, but really the political power rests with the three parties of Greece, and if they cannot be convinced of the political appropriateness of these negotiations, because they do have a political, their objective is political. They are politicians. I think Mr. Papademos must have their support in order to make this work.
It's the kind of issue that is terribly easy to demagogue from the outside, and it takes a certain amount of political courage to sign on and make a common front, taking actions that are universally or nearly universally unpopular. And that's the question that I think the Greeks are facing now. The home of democracy, well, democracy has its awkward features, and they are now encountering them. Any other, before we open it up in a broader way, any other observations that either of you would like to make on how this is going, and or where you think it's going to go? If you want to make a prediction, we'll probably know within a week as to a lot more about Greece.
I've saved those for Vegas.
I see a few people from my class in the business school on debt markets, and they know that I've recommended to them that they read a 62-page document, the European Stability Mechanism Treaty that I mentioned a few moments ago, as a model for the financial stabilization. And what will be needed coming out of this is a similar document for the fiscal discipline that's needed to get Europe through this over the next 5 to 15 years. It's going to take that long. And right now, we do not have such a document. The proposed fiscal discipline measures, that so-called 25-nation measures that have been approved by the European Commission and remain to be ratified, those are merely words. We really need far more than that. And I think we won't, looking forward, as you say, I don't think we will really come out of this either until the disaster happens and the Eurozone breaks apart, which I think is relatively unlikely, or such a document that really binds Europe fiscally together in a much tighter way that has been suggested to this point is achieved. And that's not going to come in one step. It's going to come through moderate crisis after moderate crisis as people step to the brink and use the pressure of markets to help their people understand that they need to be more flexible and give up some sovereignty. And that is going to take a long time and a lot of heartache. So this is so intractable, it's not going to come about through a weekend negotiation or even a year of hard work.
How close do you think that Merkel and Sarkozy's proposal comes to what you have in mind?
Well, first of all, we have to ask how close they are to each other, which is not that close, because France is right on the teetering, on the border between those that will be assisted by European financial stability and those who are assisting, which are primarily Germany, the Netherlands, and 1 or 2 other small, highly creditworthy countries. I think Ms. Merkel is more committed to the Eurozone than is President Sarkozy. I think Chancellor Merkel will do a tremendous amount to try to get the German people to go along with her and provide economic support, because it is for the ultimate, in the long run, it's for the good of Germany as well. France is a somewhat different situation. It stands to benefit from Germany's largesse, basically.
And Ms. Merkel does not preside over a three-party unity government, so she's got political realities that are not altogether under control.
Right. It's an important thing to remember that every time we hear that an agreement has been reached, it's subject to ratification by each of the European member states that's so-called a signatory to that. And so it's 17 just for the Eurozone.
Right. Okay, I think we can open up to questions from the audience. Just name your victim. Yes.
Professor Duffy, I'd like you to expand on your non-disaster scenario, say for the next 5 years from a world economic standpoint. There's still going to be a tremendous amount of debt and austerity measures that have to be put in place.
Agreed. There's a lot of disagreement on how much austerity and of what kind. So over the next 5 years, the non-disaster scenario will still include a lot of minor disasters, possibly moderate disasters, but no complete meltdown. I described a few moments ago the fact that each one of these brings us another step towards a healing process, a restructuring of Europe, but that they are painful steps. So this will involve deep restructurings for Greece and Portugal of their sovereign debt. It'll involve shoring up the capital of the European banks, because they tend to be the same as the sovereign goes down, and they work together with their own sovereigns. You can't solve the situation without recapitalizing those banks. It will involve this European stability mechanism has to be capitalized. Right now it's being run like a private equity firm. You demand capital when you need it. It needs to have solid commitments to capital, more sizable than currently envisioned. Right now it's 400 to 500 billion euros. It has to be much bigger. If you're going to put a stop to any talk about Spain or Italy melting down, you're going to have that mechanism much bigger. It's going to have to be available to support banks with capital. The ECB can only provide liquidity, not capital. And at the higher level, it's going to involve the same kinds of treaty ratifications that are going to be necessary to pull together more fiscal discipline. That's not going to happen within 5 years, I predict. I think that's going to take much longer. The Eurozone will probably make it through on that muddling through. there is this possibility, as I mentioned earlier, there are bright spots in that larger scenario of not disaster includes, for whatever reason, a turnaround in European growth, which will generate there's a tremendous lack of unused capacity in Europe. Just look at the unemployment rates and the holding back of investors, the amount of cash sitting on the sidelines. Should things start to look brighter and that snowballs, Europe could grow its way out of this problem. Again, not curing the long run problem, because 20 years from now we could be back in the same situation unless they restructure their fiscal union.
Yeah, an analogy that I've been led to draw with some of my more skeptical German friends is that we are sort of on a cusp that is not unfamiliar to the United States. We had the Articles of Confederation, and the Articles of Confederation were a weak government with very weak fiscal powers, and that could have disintegrated, particularly if the war had been, independence had been lost, and instead went over to the other, to a stronger federal government and the Constitutional Convention. That took place in an amazingly short period of time in this country. But of course, things were in many ways a lot simpler in this country. You didn't have all these different nationalities, languages, historical enmities, and so on to try to cope with. So which way they're on the cusp, which way will Europe slide? I think is sort of the question that's open. Yeah.
I have a question about credit default swaps and contract law. And I apologize if you covered this before, but again, I'm pretty interested in the fact that the Greek negotiations have had as a primary aim to avoid triggering an event of default under credit default swaps. And participants in the bond markets find the notion of somebody taking a loss in the range of 50 to 70%. To be able to distinguish that from an event of default is really a miraculous acrobatic feat, I guess. But furthermore, it's been our understanding that there may still be holdouts, even if they come to an agreement, and that therefore you would need to, the Greeks would have to pass collective action to force the holdouts into the deal. And my understanding has been that that absolutely would be an event of default under whichever the relevant European law is.
Well, the ISDA agreements, actually. The ISDA
under the ISDA agreements.
Yeah.
Could you comment on this more broadly? Because it's pretty interesting that people who participate in the credit default swap markets, that they're really sort of risking the rule of law globally to achieve this kind of narrow outcome.
You can take the first crack at that one.
Yeah, well, I'll admit to dabbling from now and again in ISDA contracts, and it's really an arcane area of the law, so I'm not going to be able to do it justice. I would imagine that I would think that even in that situation where there was a holdout, that it's hard for me to extrapolate from that than the triggering of the contract with respect to the whole particular bond in question, right? As opposed to perhaps just a triggering of the contract with respect to that particular bondholder. But the truth is, that's a degree of detail I don't know.
So I can comment on that. First of all, putting it in context, the triggering of the CDS is not a cataclysmic event. The event of forced default would cause the ECB some other problems about whether to accept Greek bonds as collateral, for example, and other investor concerns. But the actual triggering is there's $3.5 billion on about $350 billion of bonds, so it's not a massive deal. How it happens? Basically, some bond investors would have to say, no, I do not volunteer to take part in this restructuring. I refuse to do that. If that were to happen, then the CDS contracts, any single investor that would be not accepting the deal and getting harmed would trigger those CDS, all of them. And the market is assuming that that's going to happen right now to ensure $100 million, 100 million euros of Greek debt with credit default swaps costs 66 million euros. Now, the participants in that market are not dumb. They're not paying 66 million to cover 100 million in bonds under the assumption that it's probably not going to happen. They're assuming that it's very likely to happen, and that if it does happen, the restructuring will be very deep. And I would agree with them. I think it's unlikely, even if these negotiations with the selected investors come off, there will be hedge funds and others not participating in the talks that will refuse to participate. And if they are also asked to, or told that their bonds will be restructured, that will kick off the CDS. Don't expect a disaster when it happens. It's not such a big deal after all.
Your reference to CACs, which are collective action clauses, which means that under what used to be standard debt indentures, if you were going to modify the principal, that took unanimity. Everybody had to agree that they would forego part of the principal. A collective action clause says that you can force at some lower level, 75%, 2/3, something like, you can force a write-down on even those who would not agree to it. But the collective action clause has to be in the bond indenture. And so now the question is, of the debt you're talking about, how many have collective action clauses?
Well, I don't know if the practice differs in Europe, but in the U.S., it's still generally the rule that unanimity is required to reduce principal or delay payment.
Very few European sovereign bonds, including essentially none of the Greek bonds, have collective action clauses. However, the Greek Parliament arguably has the right to insert them by a change of its laws. An attempt to do so would certainly generate some lawsuits, and Patrick's colleagues would no doubt have another assignment.
Yeah, we have a constitutional provision that would make that difficult.
Yeah,
Whether the European Court of Justice could somehow find a similar barrier to doing it, that would be an open question. I don't know.
Yeah.
More questions?
Yeah.
Student questions first. Take student questions first.
Well, are there, okay, over here.
I was going to ask, a lot of the countries that are facing debt problems are countries where otherwise we might think there was a pretty strong case for Keynesian stimulus based on the recession. How do we square the resolution of the credit situation with the need for maybe need for government spending? It seems like there are two dangers. One is that harsh austerity could harm long-term growth in a way that may harm long-term repayment, and on the other hand, the default could worsen an already bad macro situation.
Okay. Well, you've got people lining up all across this issue. I mentioned earlier, it's one of the most controversial and interesting issues in the whole deal, not just in Greece, but across Europe. How do you treat a financial situation that they're facing now in terms of over-indebtedness? Do you cut back on government expenditures and reduce economic activity and possibly slow down the economy and make it harder to pay down the debt? Or do you actually spend more and try to stimulate the economy as the United States and China did in the last recession? These are not easy questions. Paul Krugman, for example, would suggest this is the time to spend more.
Always.
What I would make the distinction between is that not all government spending is alike. And what Greece is being asked to do, while it has dramatically increased unemployment, is not a general reduction in government expenditures. A large part of it is privatization of government assets and a lowering of wages of government employees, a reduction in holiday hours of employees, maybe I should say holiday weeks of employees, and basically a radicalization, a radical surgery on its civil service. Now that will have some negative consequences for growth, but I would say those kinds of austerity measures are probably going to be needed in Greece. It really does have a bloated government sector. On the other hand, it would be a great time for Greece, perhaps with the assistance of Europe as in a sense of a Marshall Plan, to spend a lot of new capital on infrastructure, new industry, subsidizing startups and the like. And it's not as though they haven't thought about that, but they're not 100% well organized at this point.
It isn't altogether just a matter of do I choose A or do I choose B. because you're in an external environment that imposes some constraints. If the the course you would like to choose is B, and that is to ramp up government spending, where does the money come from? And if the answer is, well, you borrow it, then there's an external constraint. And that's what Greece is up against. They've pushed it to the wall, and now it's very dubious that they could go to capital markets for borrowing, so they would have to be going to the rest of Europe for, quote, borrowing, close quote. And so there's an external constraint. It's not just a matter of a domestic choice. Yep.
In corporate distress situations, you have amend and extend agreements that are worked up, and it was common in the U.S. a few years back. Why don't you see that tactic playing out in the sovereign debt crisis in Europe?
That's precisely what we are seeing.
Yeah.
Every one of these additional tranches of the Troika official support from the European sovereigns, and from the IMF, and from the EFSF, those are all conditional. So these are basically amend and extend. You do steps A, B, and C, and the next tranche of debt will arrive. These are not bond covenants where you're going, as a bank would in the U.S., say, okay, if you pay us a fee, we'll relax this covenant. They're kind of the opposite in the sense that if you improve your fiscal measures, we will extend your loans and provide more.
The latest wrinkle in that one is that rather than just simply saying, okay, you've agreed to the conditions, here's the money, now the Troika, the external funders, are becoming, shall we say, a little less trusting. And the recent suggestion is that, okay, you agree to the conditions, here's the money, we're going to put it in escrow. And we're going to constrain the uses that you make of the money because we have to approve the withdrawals from escrow. If you say that you're going to use the money to pay down debt or pay debt interest in principal, then we're in a position to make sure that that is how the money is spent. If you would like instead to use it to maintain lifetime employment for Greek government employees or something like that, the money does not come out of the escrow. So the conditionality is getting a little more severe.
Germany has gone as far as leaking a document that suggests that in order for them to continue to participate, they would require that Europe take over a significant part of Greece's fiscal authority. So they would literally step in, in the same sense that a state might step in to take over a municipality that is unable to meet its obligations. That leaked document, I am guessing, was
tactical.
I
think that was tactical. That would cause a political firestorm.
I think we'll just take 2 more questions.
Okay, so following on that, what do you see, how would you like to go out on a limb and try to predict whether any further fiscal consolidation in Europe will occur, potentially with shedding off some of the weaker members? And I'm not just talking about Greece, but just consolidating around the core of fiscally more sound countries.
Shall I handle that?
Sure.
Okay, so because of my remarks right at the beginning about the historical context for this, I think it's very unlikely that the core of Europe will encourage some peripheral countries to leave the Eurozone. If Greece does not cooperate sufficiently, it will be suggested that it take a time out. But by and large, I expect the Eurozone, because of that moral commitment, especially by Germany, to the Europe project, I suspect the Eurozone will by and large be intact at some cost in economic growth indefinitely, and that the fiscal discipline necessary to prevent growth from being really bad will only come about over the course of many years, punctuated by a series of crises like we've seen over the past months. And this so-called muddling through scenario seems to be right at the center of the non-disaster larger range of non-disaster possibilities. And I think we all should be satisfied if we can get this muddling through scenario to be realized, because the danger of a disaster scenario is much scarier.
On that inspiring note, Kendall, would you like to close the session?
With a new question or just close?
Up to you.
We can probably take one more question if anyone has it.
I've got a question about what the precedent is for, say, bondholders if a country leaves a currency union, and is that an instructive exercise? So say I'm a bondholder of Telefonica and Spain leaves the euro. Should I be expected to be paid back in euros by Telefonica? You know, now Deutschmarks, for example, or should I expect to get paid back in that number of, you know, whatever the new currency is? Is there a way to think about that in a precedent, or is it, who knows, we'll see?
I'm glad you ended on a legal note.
Yeah,
Go ahead.
it's a little bit of both. I think, you know, if one nation leaves the euro still exists, and a bond denominated in euros is still going to be required to be paid in euros, and interest payments are going to be required to be made in euros. What I was alluding to earlier was about a year ago in the U.S., when a U.S. company issues a euro-denominated bond, which they do from time to time. People were starting to think along these lines in terms of, well, what if the euro's not there? And then what does my bond represent? And for a lot of bonds, that question is unanswered. The indenture doesn't say what happens in that circumstance. You know, more recently, some of them have taken steps to have a fallback provision as to what currency is going to be the currency that this bond is denominated in those circumstances. And it might be, I'm forgetting right now, I remember looking at it about a year ago, but it might be a certain number of states. And if, you know, because again,
Swiss francs, dollars.
well, it could be one nation's currency, or it could be this notion that there'll be a replacement, and maybe, you know, if it were to happen, and maybe that replacement is 5 of those countries as opposed to 17 of them, you know, and perhaps that is what the bond is then represented in. But for a lot of them, it's just unknown.